Rebecca Hahn is an associate professor at of accounting at the University of Maryland. It's all yours.
Good morning. Welcome to the very first session. My name is Rebecca Hahn. I'm on the faculty at the University of Maryland. How to measure the economy is undoubtedly an important question. And the more important question is, how do we do it right? We're excited to have two experts on this panel who will share with us their views on this topic. It's my great pleasure to introduce Dr. Mary Bath from Stanford University and Dr. Dennis Fixler from the Bureau of Economic Analysis. Dr. Mary Bath is the Joan E. Holmgren Professor of Accounting at Stanford. She is a renowned researcher who has won numerous awards, including the Lifetime Achievement Award from the Financial Reporting section of the American Accounting Association. Her research focuses on financial reporting issues. Her work on the value relevance of accounting information, such as fair value accounting, has been particularly influential to standard setting. Mary has been actively involved with standard setters at the highest level. She was a member of the International Accounting Standards Board, and since its inception in 2001 until 2009. Mary has also been a standard setter as a scholar. She has served on editorial boards of several academic journals, and she's currently the senior editor of the Accounting Review. Our second panelist, Dr. Dennis Fixler, is the chief economist at the Bureau of Economic Analysis, the BEA. That's where we get our national GDP. At the BEA, Dennis is responsible for the source data and the underlying methodology of the national accounts. He's been involved with many interesting projects, including working with the National Science Foundation and the Census Bureau on the capitalization of R&D as investment. Prior to joining the BEA, Dennis was the chief of Division of Price Index Research at the Bureau of Labor Statistics. He has written extensively on measurement issues related to the national accounts. Before I turn the floor over to our panelists, just a few words on the format. Mary and Dennis will each share with us their views on measuring economic activity, and we'll then have a moderated discussion and end with a Q&A from the audience. I'd like to ask the audience to hold your questions until the end. Without further ado, let's welcome our panelists.
Good morning. I'm delighted to be here. I'm particularly delighted after Ryan's comment that he was turning the podium over to the younger faculty. I wondered how I got invited, but now I know. But as you know, I'm not a macro economist. I'm not a macro accounting expert. I'm here to learn just like the rest of you, I trust. We heard a lot about that this morning from Richard already. I'm going to do my best to give you the perspective, the accountant's perspective on some of this, and then I hope to learn from Dennis and the rest of you over the next day and a half. I want to start with something that is hopefully familiar to the accountants in the room. We call this the blue diagram. Those of you who are not accountants, this may be new to you. This diagram is to answer the question, what is accounting, to students in their very first course in accounting. That's what it was designed for, but I don't know about the rest of the accountants, my colleagues in the room. I use this in every course that I teach, whether it's a PhD course or advanced accounting course, because to me, this is accounting. Starts with economic activity, goes to shades of gray. There are accounting judgments and critical thinking that's needed in order to provide useful information to support decision making. And ultimately, good decisions hopefully will lead to a more prosperous society. And all of these have consequences and feedback loops. So this is the way we think about accounting. And even though it wasn't designed this way, I think you can almost think of this as going from micro to macro. Not exactly the way it was designed, but I don't think it's too big of a stretch to think about that this way. We accountants think of ourselves, for better or for worse, as the information providers in many respects. We Lots of people use our numbers. We create the numbers. That's a huge responsibility. And when I come to a setting like this, it's actually a bit scary because, of course, we know where all the bodies are buried in the accounting. And as was mentioned earlier by Trevor, some other people come along and take our numbers as if they really mean something. And we like to think they do. I've always thought about our finance colleagues who use book to market as a measure of risk. And I said, I know accounting is very powerful and important, but we control book. And the thought of being able to change book and change risk is that's a pretty heady thought. But that's what I mean about scary. The financial reporting has a particular objective in mind. The objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. That's a pretty specific objective. That's the objective of the FASB, the IASB, in creating financial reports. Not everything meets this objective. And I think if you think about what we're going to talk about in the next day and a half, doing macroeconomic forecasting and GDP, supporting GDP, those sorts of things are not part of this objective, which makes me a little red flag go up to say, wait a second, caution, what we're doing is not designed for these other purposes, and therefore maybe we need to think twice about just taking the numbers and applying them. One question, of course, is do we as the accountants achieve the objective that we set forth to achieve? Well, earnings is a performance measure. I think we would all agree with that. Well, I'd like to think we would agree with it. But does it really measure performance? That's a question that many of us spend a lot of time studying. We don't measure it directly. We don't measure earnings directly. It's based on recognized assets and liabilities, and of course now we're starting to get into some of the trouble because not all assets and liabilities are recognized, and if they're not recognized, they're not there. Most are not really measured. We talk about distribution of outcomes and estimation error. Richard talked about this before, but in order to do that, you have to know what the objective is. What is it you're trying to measure, and then figure out what the confidence interval is around it. Many of the assets and liabilities we don't actually measure. We calculate them in a variety of complex ways, and therefore it's very difficult to figure out what the confidence interval is around these numbers, depending on things that happen in the economy. As I said, not all are recognized, most notably, of course, intangible assets, and there'll be a little bit more on that later. We've talked about the new economy and some of its challenges. There's this other pesky thing called other comprehensive income. Some people think of that as part of earnings. Some people don't. Most people don't. Pick up net income. You miss this bit. So that's something else that needs to be, sometimes gets forgotten and swept under the rug. Of course, we all know that our accounting is conservative. So this is not an unbiased estimate of anything. We treat positive things differently from negative things. And of course, subject to earnings management, this discretion that we talked about. So there are many reasons why net income is not the perfect measure to hand off to our economist friends and let them go forward and make big decisions based on it. So one question I asked is whether other accounting amounts can help, and I wanted to share with you this morning a little bit from a paper that I'm currently working on that has to do with this issue about what else besides earnings, and particularly in the new economy. So yet another paper on evolution and value relevance of accounting information, and Dan Collins is in the back row. He's worked in this area. This is a study where we use some of the machine learning type techniques that Richard was talking about to estimate value relevance, but the point is to try to see what's happening as we march through time, as the new economy evolves. And this is full sample. We have a lot of accounting amounts. They're listed up on the side, but we start with net income and book value of equity, R&D expense, recognized intangibles, advertising expense, revenue growth, cash, cash flow, revenue, special items, other comprehensive income, dividends, CapEx, cost of goods sold, SG&A assets, and industries. And what you see from this graph is something that we've known from prior research, and that is the relevance of net income is going down. But what's the interesting part to us is other things are taking its place. Many other accounting amounts. It turns out that we've found that over time, the relevance of accounting information that we look at is pretty constant. I mean, it bounces around, but there's no clear trend really one way or the other. Because what's happened is different things have become relevant to valuing firms. This is all relative to valuing firms. But as you can see from the pie chart, it's a full sample. From the 60s to 2010, net income was most of the action in the 60s. By 2010s, it's cut pretty much in half. And other things such as cash flow from operations, book value of equity, revenue growth, revenue have taken its place. So this is starting to say, gee, maybe just this reliance on net income in some of these calculations is not quite enough. We break the sample up into what we call new economy firms based on how prior research thinks about these young tech loss firms. And the change is all the more dramatic. I don't know if you can see, but on the right-hand side, we have intangibles, growth opportunities, and alternative performance measures, which are barely noticeable in the 60s, now make up the lion's share of what explains value. And this is true to a lesser extent in this first graph. But if you look here, also in this, we started here in the 70s. The 70s net income was explained three-quarters of the relevance of share prices. And by 2010, it explains less than 10%, let's put it that way. That's why it didn't make it to the pie chart. But all these other things do. R&D expense, revenue growth, cash flow, things that are more important in the new economy. We looked at several other cuts of the data, but one was new economy profit firms. You think of those as maybe not affected by the new economy, but it turns out they are. The pattern is the same. It's just a little less pronounced than with the new economy firms. So it seems that the economy is becoming the new economy, or the new economy is becoming the economy. It's not limited to a few firms. And this just cautions me to say, wait a second, if we're going to start using some accounting numbers now, beware of just using any one of these numbers, frankly, let alone net income. So reliance on one is going to present an incomplete picture. And then what about differences in accounting standards? Richard mentioned this briefly this morning. So far, a lot of the talk is about U.S. GAAP. This is the numbers that we use in this study, and I think that's when we talk about what we as financial accountants do, that's what we're talking about here in the United States. But that's really only required for publicly traded companies. And in the macroeconomy, there's lots of other things going on. What about private companies? What kind of numbers do they report? And where are those numbers? How do you get a hold of those numbers? And nonprofits, let alone households. I mean, these folks take into account households. I'd shudder to think about what my financial statements would look like if I drew them up. And I don't know how they manage this. There are also differences in accounting standards around the world. So it's very difficult to just take accounting numbers and aggregate them up and not be adding, to borrow a phrase from Trevor's long ago, think you're doing apples to apples when you're really not. And getting apples to apples is a daunting task. Not hopeless, Richard, not hopeless, but daunting. So not being a macroeconomist, I started thinking, well, what does this suggest for GDP? First is effective different objectives. If we share an objective, then we can talk about how we're getting there. But if we don't even start trying to do the same thing, it shouldn't be any surprise we don't get to the same place. And I think, as I said, the objective financial reporting is focused on investment in the firm. And what investors need to know about investing in the firm is they care about a lot of things. They care about information asymmetry. They care about management's discretion. They care about opportunism. They care about idiosyncratic as well as systematic risk. They care about cash flows coming back to them, which I would think is quite different from the objective of putting together numbers to inform government policy or other things that we use for GDP. Then this issue also came up in the Q&A this morning. What about aggregation? Well, I think idiosyncrasies probably should average out. That's kind of what the name of the game, right? Law of large numbers. That's okay. But that would only, so that we could stop there if we thought the financial reports were all unbiased estimates of something, just with noise. It's not true. And one thing we know, there's this question about cash flows at the firm and market discount rates. Cash flows go up, discount rates go up. Discount rates, some people think they should be going down. And the question is, how much does this impact the GDP calculation? I don't really know. But intangible assets, I mean, there are numbers in the financial statements, as you can see from the graph, that are correlated with intangible assets, but we don't really make any attempt to account for the values of intangible assets of a variety of time. Conservatism, so if you aggregate up zero, you're going to get zero, or aggregate up some R&D expense, you're going to get a number, but it's not going to be the number you want. Conservatism, as I said, in many respects, that introduces a bias in the accounting, and so when you aggregate that up, I don't see how that would dissipate. Common incentives, so firms manage earnings, and when the different points in the economy cycles, you would think that there be some systematic component to their incentives, that they would be coloring your earnings one way or the other, perhaps. And I don't think we've thought I haven't thought about this. Maybe many of you in this room have thought about how firm-level incentives affect the numbers in the macro calculation. I really don't know. But I just kind of put an X through this. I don't think this aggregates very well, any of this. And then, of course, the different standards, this doesn't aggregate at all. Even the expected loss, you mentioned, Richard, IFRS does it one way, US GAAP does it a different way. Similar, that's the word we like to use. Same, no. And so it's an apples-to-apples question. So the question we're left with is, what do we need to do? Accounting likes to think of itself as a learned profession, which means we academics do research, we talk to people in practice, and we try to have our research inform practice and learn from practice and do some research questions that they're interested in. I think the whole point of the next day and a half is to talk to each other and to try to bring, at least for me, bring the macroeconomy into what I think about when I do my research, when we all do our research, and that maybe academics here can help sort some of this mess out so that we get good data for the macroeconomists to use. So I will look forward to learning from Dennis.
Thank you, Mary. Now, Dennis is going to share his point of view based on his experience at the BEA.
No, that's fine. Where's that full screen? I'm looking for the full screen here. Yeah, that's what I thought. No, it doesn't want to do. There we go. Well, I'm happy to be here today to talk about macro measurements. Richard mentioned BEA quite a few times. So what I hope to do today is to, at least in the first part of my talk, give you some basics of what BEA does, how we put the numbers together a little bit, and then talk about some very topical measurement issues that we're confronting. So our mission is to promote better understanding of the U.S. economy, timely, relevant, accurate economic data, objective, cost-effective, comprehensive measures, and as was mentioned, most of the data that we get from other statistical entities, and that's part of my job. So we only collect about 20% of our data and it's in the international services, transactions. So we survey multinational enterprises. We do the international investment position, balance of payments, and so on. And I spend a good chunk of my time with the Census Bureau, who is our major source of data, about the data they collect from firms and then how to get it into national accounts. And we spent, so for example, for the economic census that was just sent out to firms, we spent about 18 months with the Census Bureau going through all the different questions to make sure that they were going to ask questions that were going to be useful for us for producing the national accounts. So the national accounts is a very broad concept. So you're familiar with GDP and its components, personal income, corporate profits. As I said, we do the international accounts. We also do industry accounts. Richard mentioned those, the input-outputs, GDP by industry. We have some satellite accounts. Travel and tourism is one. We have a health satellite account doing health expenditures by diseases, which was something that we started a few years ago. Regional accounts, GDP by state, state personal income. These are extremely popular products by the states. They come to us a lot. The regional multipliers that we produce are products that state and local development agencies use to get the numbers to say, if you build a stadium in our city, this is the impact on employment, this is the impact on business in the area. These come from the regional multipliers that we produce. So, as Mary pointed out, part of the story is about objectives. And so, national accounts, what do you want to measure? And for us, that's always like, what questions do you want to be able to answer? So one thing that we always get asked about, and it's very topical, of course, is business cycle analysis. So we need comprehensive pictures of aggregate economic activity, and we want to be able to talk about expansions, recessions, and the like. So because this is what people are interested in. So if you maybe remember from Principles of Economics course, the underlying foundation here is this basic circular flow model. We have households, firms, and we're trying to measure these two flows: expenditures by households on firms, which should be equal to sales, and payments by firms on income. So one of the relationships between accounting and business accounting and national accounting, everybody uses double entry bookkeeping. In the national accounts, this is the international standard, the system of national accounts, which is an agreed upon standard of producing national accounts. It's the IMF, the UN Statistical Division. It's quadruple bookkeeping. So not only do we record the two entities engaging in the transactions, we go to the financial accounts and look at the corresponding transactions. So when a household pays for a good, it's maybe withdrawing funds from its checking account. So these are the kinds of things that we try to do. The circular flow model that I put on, of course, is very simplistic. We have the government, we have and the international sector, cross-border transactions. So one way of looking at the difference between national economic accounting is it's the different objectives that Mary talked about. We're looking at national economic activity. And our customers, policymakers, business leaders, investors, and a lot of academic researchers. U.S. GAAP, individual accounting, managers, investors, and creditors. So there's an overlap, but there is a substantial difference in the interest. So when we get this data from the Census Bureau, for example, we typically get from their reporting firms, profit and loss statements, and we make a series of adjustments that Richard talked about, and then we come to the production account. So generally, when we focus on the national accounts and GDP, which I'll talk about in detail a little bit more, it's a measure of aggregate economic activity, it's production in the economy at a point for a reference period. So we want to avoid double counting. Since GDP is a final demand concept, we want to eliminate sales to businesses, and a lot of things are net inventory changes, net exports. And it's not just about the transactions. We need to know where the sectors that the transactions are taking place. So we want to have customers, households, business, government, and then we want to go by industry, so input-output accounts, the supply-use tables that we produce, and then we go by geography, exports, imports, and then again, balance of payments. So I thought one way of just putting this up in one chart is to take a very simple relationship between the two accounting systems. So you see that there are a lot of corresponding entries, but there are some very different ones. So our consumption of fixed capital, for example, is very different than business depreciation. Okay, we focus on this concept of value added. We have net operating surplus, which is profit-like measure, but not exactly. We have property income, which is much more so than net interest. And then we look at this broader concept of a net entrepreneurial income. So the link I put at the bottom, it's to a working paper that works through a lot of these different accounting relationships. It's a paper that focuses on R&D expenditures, and so it goes on into the difficulty of bringing those into the national accounts. But for us, we have to treat everything in terms of being able to understand movements over time. You know, though we provide point-of-time estimates of things relevant to some reference period, everybody wants to know what happens over time. It's GDP growth rates and so on that's the focus of attention. So all the data that we get can be looked at as one big, broad price times quantity. And if we're looking at nominal values, current dollar values as they move over time, it's essential for us to be able to break down those movements into movements that are associated to price change and movements that are associated to quantities. And the creating the measures of price change, which is where we focus on, is what allows us to have the implicit measurements of quantities. The measurement of price change is extremely difficult in many areas. And I'll talk about, in particular, one of the measurement challenges I'll talk about. So GDP, technically, total value of final goods and services produced in the economy within a period of time. We measure GDP three different ways. Expenditures, this is what everybody talks about, consumption, investment, government expenditures, exports minus imports. Income, wages, compensations, profit, so on. Production is the feature one. This is the value added. Sales minus intermediate consumption, essentially. In concept, they should all be the same. In reality, they're not. In fact, between we produce and our tables that compare the expenditure approach and the income approach, we have this entity called statistical discrepancy, exactly to tell you they're not the same, and this is by how much. The reason that they are not the same has to do with the flow of data that we get into BEA. So, for example, we get tax data with a 2-year lag. So the income data is not as timely as the expenditure data. That's why we feature the expenditure side, the C plus I plus G measure. Production approach, we're working on an independent measure. Right now, it's controlled to the expenditure approach. So what I thought I would do with the remainder of my time is spend some time talking about measurement challenges that we face and hopefully set the tone here for some of the ways where accounting can help us. So GDP is a measurement of market activity. And so the question then becomes how to include non-market activity, which everybody's concerned of. So a topic that's been around since 1950s is household production. In some countries, household production is extremely important. In the U.S., becoming more so. And so what we did a few years ago is we started an account about how to measure household production. And we weren't able to do this until BLS started to create a time use survey so that we could find the activities of people in household production and then work at how to value the time devoted to different activities. So for example, childcare, how much time is devoted to it, and then we could take alternative wages for people that provide childcare and impute an estimate of the value. But it's not all about labor. Household production entails capital. And so now we have that. We also have now sharing of capital equipment, right? Airbnb, so is that household production here? How do we value that in terms of household production? Aggregate economic activity. So another part of the non-market activity, how do you value things for which there's no explicit payment? Google, Facebook, they're all producing something. How do we value it? So it's true that they're financed by advertising expenditures. So do we take that as the value of the production? In government, in the case of government output, that's what we do. The cost of government is the value of the output of government. But for these kinds of things like Facebook and Google search, it's not clear that that's what we should do in terms of the value of the activity. Mary mentioned intangibles. Since 2013, we have spent a lot of time incorporating intangibles into the investment component of the national accounts. So if you go to our gross domestic investment table, you will see a line there, intellectual property products, and it's broken down into software, equipment, and artistic originals, literary originals, and so on, because of the importance of this to the economy. A lot of discussion these days about the digital economy. We've been dealing with the digital economy since the 90s. We have different reports here. There's a working paper that BEA produced recently about how to define the digital economy. We have a main problem here is what to count. What's the digital economy here? So we define it as basically internet-related activities, ICT as we call it, information and communication technologies, equipment, software, e-commerce, all the kinds of things that you can think about, we try to estimate and put into this digital economy measure. But part of the problem here, again, is we get a nominal value interested in changes over time. So I mentioned the problem of price change. So in the realm of ICT equipment, computer equipment, for example, for us to look at price change, it's essential that we identify the part of price change that's due to change in quality. And that's extremely difficult for a lot of these digital products. We can do it fairly well for computers because there are identifiable characteristics, memory, speed, clock speed, and so on. But for a lot of these products, cell phones, everybody's got one. How do you value the quality improvement when you want to take away the price change? So it's extremely difficult to do that, but unless we do it, then the measure of output and productivity will be biased. And if you look at the economics literature, much discussion about how to measure productivity. Right now we're in a current period of productivity slowdown relative to the past. And one of the issues here is how much is measurement a part of this measured productivity problem that we have here. And a lot of it, some people say part of it is this measurement of price change. And then we have the issue of measurement of just new goods and services, period. And finally, I'll raise another issue here for us, globalization. So transfer pricing has been an issue for a long time. It's supposed to be an arm's length transaction, the values of which we can ask firms to report. But I think everybody in this room knows that those are largely driven by tax law and not necessarily economic valuation. We have contract production and what we call in national accounts factory-less goods production. Apple produces cell phones. The way it does it, we would technically put it as a wholesaler because there isn't an Apple production plant in the US, and the same with a lot of other goods and services produced. So how do we take into account contract production. When we have surveyed firms, for example, in factory-list goods production, firms were not able to answer our forms. They had no idea what we were talking about. They had said they could not even begin to answer these kinds of questions. Parking intellectual property at foreign affiliates. This is a big one. Recent cases, the Irish, because of all the parking that goes on there, their GDP in 2015 jumped 26% in a quarter, and everybody goes, this cannot possibly be true. It wasn't. It had to do with royalty payments and the like that were being assigned to the Irish economy because of an increase in sales of a special purpose entity in Ireland. So we need to decompose consolidated information into its components. Mary talked a little bit about that, so that's another measurement challenge for us. And we do employ accountants. 45 of them work in our survey forms for multinational enterprises. They are the ones that try to reconcile how firms respond to us versus what they report on SEC filings, tax returns, and so on. And they spend a lot of time trying to reconcile differences. And then we have about 14 accountants in the balance of payments division. So we're very much into the accounting aspects for business transactions, except we come with it a different way. So I look forward to the next couple of days, and hopefully we can, you can help us get better numbers.
Thank you, Dennis. So let's go straight to the facilitated discussion. So my first thought is going back to something Richard mentioned earlier. How do we bridge the micro-macro, right? How can we integrate the two views? So my first question is for Dennis. What do you think can standard setters do to help, right? If we have a perfect reporting system, in the sense that economic activities can be measured perfectly at the firm level, right? Putting all the limitations aside. Would you be happy to use bottom-up accounting numbers to measure macroeconomic activities?
I mean, we are a bottom-up measurement agency. So I'll pick up where I left off here. Decomposing consolidated numbers into components is essential to us. Because when we survey our multinational enterprises, we are interested in the activity of the parent as well as all the foreign affiliates. And so when we receive a consolidated return, then we're always asking them to decompose the activity. So any way that we can have more fully disclosed consolidated reports about sub-activities would be very well appreciated. Transactions between foreign affiliates and the parent. We need those, very much so. One issue that Mary mentioned is decomposing net income. This has actually come into play more now because of the change in the tax law. We had an interesting experience in the past couple of weeks where Alphabet was happy that equity income was incorporated into net income, and Warren Buffett was unhappy that such income losses was incorporated into net income. Since GDP is a measure of production activity, we would like net income to focus on the primary activity and have the sales of assets and the valuation of assets isolated from the concept of net income. That would be hugely important to us. Accounting for tangibles. For us, coming up with measures of own account, as we call it, internal R&D is extremely important. We have no way of valuing own account activity. And here's where something that Mary mentioned comes into play. There's a difference in treatment between GAAP and IFRS in this. One allows some capitalization and one allows only expensing. We now we capitalize R&D expenditures completely in the national accounts as part of investment. And so we take some of this, the expense stuff, and capitalize it. We work with the National Science Foundation on this. They finance a survey with the Census Bureau about research and development, and so we work with them on the questions. So I think that that's probably enough to put on the plate here.
So Mary, let me throw it back to you. Right? You ended your talk with what do we need to do, and so Dennis mentioned all these issues that you're very familiar with: intangibles, foreign affiliates. How do we decompose? And do you think standard setters can help bridge this macro divide and bring the two views closer?
Well, I think we certainly can help. The standard setters can certainly help. Whether they can actually do it all is a whole different question. I'm not sure. Any of us can. You're going to have your assumptions and do whatever you do, put whatever's in your secret sauce when you take the numbers. But I think each player has their own role to play in the system. And as long as we stay in silos, we're going to be able to do less than if we broadened it. So the standard setters, I told you what their objective is. They write standards for external reports, outside providers of capital. So some of the information that you would like to have, such as consolidating, if you will, financial statements, or more detailed information from within the company, transfers to affiliates and that sort of thing, that it may not be the standard setters who do that, the IASB or the FASB, because that's outside information, but that may have to come from regulation. Many countries around the world, it is required to file that information with the government, and you're kind of an arm of the government, or at least they would probably give you the information to use. Yes. So I think may not just be standard setters, but I think standard setters need to understand how they could be helpful, how these types of users of the financial information would be better served with more or different information. And I don't know what their reaction would be, but I have a feeling if you tell them that you base these numbers, these very, very important numbers, on tax accounts or cash flows, they would say, hold on a minute, we can do better than this. Because the objective of tax, of course, is different still from the other objectives. The IRS has to raise money, and the Congress wants to implement social policies. So those numbers are not exactly what you want either. And I think that would make the standard setters cringe, and also cash flow. I mean, we had cash flow for many, many years, and the accountants have figured out, and capital markets have figured out that cash flow is not the only answer. We have tons of research on that accruals actually add information. But I think it's a matter of what they're charged to do and what they understand, how they can help, and I think they would help. Symmetry is something, I don't know if you mentioned symmetry, I didn't catch it, it was in your slides, but we never try for symmetry. As a matter of fact, we purposely don't in many cases, because the liability of one firm is a receivable to another firm. And we don't touch the liability until it's paid, but if there's some question whether the receivable is going to be collected, we have an allowance for bad debts. So you start adding things across, this is a whole nother issue. Leases, capitalized leases on the lessee's books, but not, the lessor probably still has the property, plant, and equipment, you're getting it twice. So there's all kinds of ways that this is a problem, and symmetry is something standard setters never think about, because they're trying to account for the entity itself, not how that relates across. In a perfect world, you probably get it, but anyways, I think standard setters could help, but they're not going to get you everything you want.
Well, this is clearly a conversation that we'll have to continue in the next 1.5 days. My second question is related to the new economy, right? Both of you touched on it in your presentations. How to measure the new economy is important at the firm level, at the aggregate level. But the definition of new has evolved, right? If you think about it, in the late 90s, we have the internet economy. and then we have the e-commerce. But in the last decade, we saw the emergence. We heard a little earlier, right? We have social media, we have mobile commerce, we have AI, we have sharing economy. The list goes on and on. Let me start with Mary. Right? You talked about how the value relevance of accounting information has evolved as the new economy developed. How have the challenges of measuring the new economy changed?
I don't know that the challenges have changed, except they're getting worse because they're inventing new ways of doing business. This is one of the reasons I think a lot of the tech companies don't know how to answer your questions. Mm-hmm. I mean, we all heard the question in Congress, to Zuckerberg, how do you make any money if you don't sell any products? That's the problem, okay? And I remember when the iPhone came out, Steve Jobs, he didn't separate hardware and software. An iPhone is a combination, but the accounting rules were different for hardware and software. And they said, you people are out of step because hardware is software. And I'm not going to charge extra for software as part of the phone. And how do I account for this given the current rules? And the answer was, we changed the rules. But I think it's old think versus new think more than it is anything else. And trying to come up with a system that's more flexible, that looks, I think, more at what you want to look at, some kind of value add, regardless of what it is. But the sales, cost of sales kind of breakdown is not relevant in many circumstances. So I think it's just the problem is getting worse because it's becoming even more so and more pervasive, not because the challengers are. R&D was hard to value or how to account for 30, 40 years ago. It's still hard. Yeah. It's more important now than it used to be.
So Dennis, you specifically talked about the digital economy, and you talked about some of the challenges in terms of measuring. How big is this digital economy? How worried should we be? And kind of where does it show up in the national accounts?
So in terms of its size, take 2016 as the example, it's 6.5% of current 6.5% of current dollar GDP and about 4% of employment. So it's not a small part of the economy. For the period of 2006 to 2016, the average real growth rate was 5.6%, which is much greater than the total growth rate of real GDP for that time period, which was 1.5%. So as we've measured it, it's huge. But again, people could quibble with the way we've put things together. So we look at the infrastructure and computer networks, digital transactions, e-commerce, digital media, hardware, software are included. But it's very difficult here because if we're going to get real values here, which is what we call the inflation-adjusted measures, the implicit quantities, we need price indexes. And that's where, we've had to do some heroic assumptions here to get real values. And it's extremely important now because, to take off from what Robert Solow, Nobel laureate in economics, once remarked, you see computers, he was commenting in the 90s, you see computers everywhere except in the productivity statistics. Well, now we see digital economy everywhere except in the productivity statistics and in the output statistics. And so how to do this? So AI was mentioned. How do you incorporate AI as an input into the production process? What's the cost here? If researchers, you're all academic researchers, most of you, you use Google instead of going to the library, what's the value of that as an input? So how do we get a value here? We are looking at measures of consumer surplus because people are now interested in sort of this welfare idea on the consumer side to the value of households and the like about Facebook and Google. That's not exactly a GDP concept, but it's something that we're looking at because it helps perhaps in the measure of the price change. So,
Can I ask a
That's-
question? Sure. Can I ask this? What does quantity mean in the digital economy? When you're taking price times quantity, I get it when we're talking about tables, but when we're talking about, what is a quantity?
in many cases, it is a very squishy concept. Because what we do is we don't calculate the quantity exactly. We take the revenue or the nominal value and deflate it by some price index to get an implicit quantity. So the quantities we have are sort of real dollar values.
Okay, so I guess that's all the time we have for this discussion. Let's open the floor for questions. So Victoria and Laura, I just wanted, when Lindsay said we need Word, I took advantage and asked two of our PhD students, Victoria and Laura. So if you can just wait till you get the microphone so everyone can hear your questions.
I'm Anup from Dartmouth College. I think my whole portfolio revolves around intangibles and its measurements and its effect on accounting systems. So I have a question for Mary. I think you brought a lot of valid points. New economy is the economy in itself. The value creation is more from knowledge rather than from atoms and molecules. The fact that value relevance of bottom line flow variables such as earnings is declining. And you also use a word, I noted the word worsening or something, but I was surprised by your graphs that in aggregate, the value relevance of accounting hasn't changed across time. And you also said that accounting should be useful to capital providers. Now, in your conversations with capital providers, do they also believe that the value relevance of accounting or all the variables hasn't changed across time?
Well, you can look at the paper online if you want to. I'm not going to go into all the details, but I was just reporting the findings from our paper. As to whether, I think many people, we're hearing this even today, that people think that the relevance of accounting has gone down. But the question is, they're used to using the accounting in a particular way. And so whether it really has gone down or not, what we look at in our paper is what's revealed in prices, as opposed to what they're actually doing, as we often do. So I don't know. I really don't know what they actually, how they view it, whether they would be surprised or not surprised at that outcome. But it's pretty clear that this net income as a summary measure is not doing the job that it used to do, and that we've known for quite some time. And I was actually struck by your comment about productivity. The productivity measures may be too low because we're missing some elements of productivity. The productivity maybe hasn't gone down, and I think that's part of what's going on, is because the intangibles has become so important in the economy, and we basically write them off. We write off the investments. And so the number of loss firms has also gone up in the economy. And that may be suffering from some of the same problem as their productivity numbers, and I think that's what our paper is showing.
I don't think we should be too surprised that disaggregating the earnings numbers into their component parts yields valuable information. We know that if we disaggregate earnings into accruals and the cash flow components, that we get very different evaluation coefficients on those components. And as we have moved from old economy to new economy, we know that there are various components of earnings, like intangibles, that we write off that have become more important. So the fact that we're able to see some changes in certain components of value relevance where the dependent variable is the value or the returns shouldn't be surprising at all. And I think we just have to step back a minute and realize that you know, we know some of these things, but we haven't always brought these to bear in our research. And so, you know, I applaud Mary for, you know, demonstrating this graphically, and hopefully we'll see from this that there are a lot of other components in the different statements that we ought to be looking at when we think about how firms or how investors, capital providers value accounting information in making judgments about how to allocate capital. So I think that's the bottom line of what you're showing.
I guess the only thing that was somewhat surprising is that because we don't do a very good job accounting for these things, these are accounting numbers. So it's not quite, just because there's more R&D, intangible assets that become more important doesn't necessarily mean that the R&D expense becomes more value relevant. So we take that as a signal that investors are trying to get whatever information they can possibly get, and it's correlated, at least positively correlated with what they're doing. And to me, it's a signal of how much better we could do if we actually thought about some of these things and did a better job accounting for them.
So I think there's a question in the back from Peter, and then Shirash and Trevor.
Thank you. I think this is a question mainly for Dennis. Thank you for both your presentations. The slide that's still up here, actually, on globalization is very interesting, and you've identified some major problems with, globalization of operations. How do you cope with the globalization of ownership claims when trying to get the domestic?
It's a very good question. So all the national accounts is based on economic ownership, not necessarily legal ownership. And so the creation of these special purpose entities where intellectual property is parked in different countries, technically it's not clear who owns them, even though legally they're in the other economy. So we have to draw distinctions here between the legal ownership and the economic ownership. When we do our multinational surveys, we try to get into this kind of aspect of it. Firms have to report this, supposedly. They're supposed to.
But if 40% of Apple is owned by European investors, then would a change from 40% to 80% be reflected in the US GDP numbers?
No, because it depends. So it's economic residency, and it's the controlling interest in them, and we allocate the returns on the money. If you're talking about individual shareholders, it's not counted. If we're talking about affiliates, is that what you're referring to? Or shareholders? Shareholders, we would not, that we wouldn't get. I thought you were talking about affiliates. Yeah, sure. We would just know that they're paying out dividends, that's all. And that's recorded in GNP, which is factor payment, which includes net factor payments abroad. So the income concept catches that, the balance of payments catches that, the international investment position captures that. It's not part of domestic production. It's more of an income concept.
Okay, I think we have time for just one last question.
Yes, Martin Lubink here. I had a question for Dennis that has to do with contingent claims and derivatives and all sorts of financial products. So I have a credit card. For a very simple example, I have a credit card, and one of the reasons that I have that credit card is that it offers me insurance for free, basically. So I was just wondering, how do you tease that out, the contingent claim or the guarantee dimension from the product itself?
We don't decompose the credit service that's purchased when you use your credit card to its components about the contingent claim or whatever. What we do in our implicit measure of the credit service that you get when you use a credit card is that it includes the risk bearing on the part of the financial institution. And so we just more or less leave it at that. We don't go into the financial accounts go into the derivatives and all these kinds of things, but they're not part of production. So from a production point of view, the only thing that we would record is you're purchasing a credit service, and that credit service has a lot of things into it, but we just leave it basically as there's a service, and then there's a risk-bearing component that the financial institution is undertaking, and I would throw all that into the risk-bearing, the value of the risk-bearing that they're taking when they give you credit. There's some probability of default there, right, and things like that.
Okay, so measuring the economy is clearly more art than science. So with that, this concludes our panel. So please join me in thanking Mary and Dennis.